Good morning, everyone. Welcome to day 7 of the workshop, and we will continue from where we stopped. And today we'll be starting a new journey after a little review of what we've done so far with respect to income taxes. And thereafter, we are going to put a little break to discussion on income taxes today, and we'll come back to it sometime when we wrap up the new discussion that we'll be starting over today. Today, we'll be introducing ourselves to business combination and its accounting implication with respect to the requirement of IFRS, specifically the requirement of IFRS 3. And that will probably lead us to extensive discussion on group accounts and how to prepare group accounts, rationale behind preparing group account, and some other things like that. Okay, and that is what we are going to do today. Now, before we do that, I want us to have a brief comment. And if I have anybody that has been able to attempt solving this problem that is showing on your screen as given to us during the week, I will more or less give that person access to share his or her screen for us to look at it together before I propose or prefer a solution. Okay, and that is it for now. The class is about to start, and I want anyone to volunteer who has more or less made justice to this problem and who is willing to share his or her screen for me to grant access. Otherwise, we'll move on from there. The floor is open. Mr. Nuruddin, Mr. Babajide, Mr. Nauro, Mrs. Grace, Mr. Shegu, and the rest. Who is willing to come up? If no one is willing, okay, what can I do now? Okay, Mr. Shegu, I want you to read the problem and let us see the preferred solutions to that, and we'll move on from there.
Should I attempt? Let me attempt now. What I did is not really full, it's a partial work, but I just felt I'm not right because my deferred tax is not equal to 0.
No, nobody expects your deferred tax to be 0. The word is 0 explanation we gave last time is to say over time, it's a temporary difference that results to 0, which is no tax. Not at every point in a year, it is 0. Okay, we can allow you to share your screen now. Do you want us? I think you have access to share your screen.
Okay, let me see.
Let me stop my own share. And you don't have access?
No.
Wait, let me stop my sharing stuff. Okay, I've stopped my own sharing. Can you do yours?
Okay. Trust you can see my screen now.
Yes.
So I just did a copy of the format that we have already to just get this done. And this is for equipment. This is for plants and equipment. The carrying amount of the asset or the cost of the asset is 45 million for the first year. We have the depreciation for 5 years, which is annually is 9 million. 9 million. The NBV for year one is 36,000 or 36 million. While for year two, it is straight line. So for till year 5. So the same thing for tax purposes. We were told that is for 3 years, and it's going to be on the 50 ratio of 50, 30, 20. So which gives us the capital allowance for the net book tax written down value of 22,500, 9,000, and for year 3 it's 0. Okay, after then I come to the current tax computation. From the current tax computation, the tax rate that was given is for just 3 years. So assuming they just want us to compute still. Okay, the question B say prepare the deferred tax account for year ended 31st December 2013. So it's for 3 years computation we are doing. So this place they say, in the question, we were told that there was a taxable, okay, we were given that the accounting profits before, the accounting profit for 2012, 2013 was 15 and 20 million. There was no accounting profit for year 1, 2011. And the last question says, the last additional information said there was a tax loss of 31 of 12,500. I believe in year 1 they made a loss. So which in this okay, I think for the land and the building, I didn't bother to go ahead in calculating the I didn't go ahead to do computation for them for carrying amount and tax, but I'm thinking land. They say land is not depreciable, depreciated. Land is not depreciated, which means I don't know. I'm stuck in that area, and also in the building. They said the building has a straight line basis for 25 years, and in the question, in the additional information 4, they say the office building is not deductible for tax purposes, but for plants and machinery. Okay, so that too, I didn't get clarity from them, so I was stuck there anyway. That's where I got stuck as regards other 2 assets. So I just did for the office equipment alone. And for the current tax computation, the accounting profits, they say there has a tax. We're told there is a tax loss of 12,500,000. So I assume that is a loss. That's the total loss for year 1. Rather than profits, that should be a loss. And add back the depreciation for year 1. We are having an assessable loss. I don't know if that's correct. Anyway, sorry. So I have assessable loss of 3,500,000. Add back the capital allowance for year 1. We do the minimum of this place too. I'm not certain, because minimum of the capital allowance or the assessable loss is giving me this is what is giving me, which is the 22 million. It's giving me a taxable profit, which I'm not absolutely correct. I think this is where I got lost.
Okay, thank you very much. You've opened the floor for us, and I picked some one or two things from what you've said. I'll use that as a narrative to further our discussion. Okay, you could stop your sharing now and let me take over. Thank you. Okay, now I want Mr. Shegun to read the question first. And I want you to read the question patiently so that people can pick one or two points from there, as those points will be our point of emphasis as we move on.
Okay, can you
Over to
hear me?
you.
Can you hear me?
We can.
Okay, question 6. Scaleo Nigeria Limited owns the following property: plant and equipment as at 31 December 2011. So the plant and machinery, which cost 45 million, accumulated depreciation of 9 million, carrying amount of 36 million. The land has a cost of 25 million, zero accumulated depreciation, and the carrying amount is 25 million. Office buildings cost of 75 million, accumulated depreciation of 15 million, carrying amount of 60 million. Additional pieces of information are: plant and machinery are depreciated on a straight line basis over 5 years. The plant and machinery was acquired on 1st January 2011. Land is not depreciated. Buildings are depreciated on a straight line basis over 25 years. Depreciation on office building is not deductible for tax purposes, but for the plant and machinery. Tax deductible is granted over a period of 3 years in the ratio 50 to 30 to 20% of cost consecutively. The accounting profit before tax amounted to 15 million for the 2012 financial year and 20 million for year 2013. These figures include non-taxable revenue of 4 million in year 2012 and 5 million in year 2013. Scaleo Nigeria Limited had a tax loss on 31st December 2011 of 12,500,000 naira. The tax rate for year 2011 was 35% and 30% for each of year 2012 and 2013. Required. In accordance with IAS 12 on income taxes, differentiate between current tax and deferred tax. B. Prepared the deferred tax account for the year ended 31st December 2013.
Okay. Yeah. Let me break it down a little. Okay. We have to compute income taxes, and we know that income taxes is made up of current and deferred tax. Okay. Now let's start with current tax. Current tax is computed with respect to what the law says. And in that light, what affects current tax? We have to compute for 2012 and 2013, and I'll answer why. Because without knowing 2012, we can't know 2013, especially with possibility of item being carried forward with respect to unutilized tax losses and with respect to unutilized capital allowance. Okay. Secondly, I won't start from 2011. Why? Because the position of 2011 is known and has been closed. How do I know? Because if you look at the last information here, which is information, as you can see it here, Scaleo Nigeria Limited had a tax loss on 31st December 2011 of 12.5 million. What that signifies is that for you to have a tax law, it means the 2011 income current tax has been assessed and computed. And as we assessed and computed implies that you are not to do it again. Rather, we are to carry it forward to 2012. Now we're in 2012. What then do we do? It's for us to make the computation as deemed appropriate. But before I move on, I welcome a new participant that is just joining for the first time today. Madam Onome Agana, please, we want to see your face, and we always have our camera on at all points in time. Thank you very much, ma'am. Okay, now let's see how we compute our current tax for 2012. Having understanding that there was a tax loss in 2011 that is required to be carried forward in 2012. Now look at what I've done. Let's look at it. Basis for current tax estimation in 2012. We'll start with accounting profit. If you remember, I can bring the question to the side here. Let me copy and paste it beside so that we can also see it at a glance. You can see here that our accounting profit is 15 million for 2012, which is what we have here, all figures in thousands. Now we are also giving information about non-taxable income in that year or revenue. These figures include non-taxable revenue, 4 million in 2012 and 5 million in 2013. What is relevant now is 4 million. If it's not taxable, what do? You take it out of this because it's already included here. And that's what we've done. Next is that depreciation was charged before arriving at this profit. And for tax purposes, accounting depreciation are disregarded and replaced with capital allowance. The question then is, what is the amount of depreciation? We'll go back to this information here. Let's pick those depreciable items. Out of the three assets here, only plant and machinery and office building are depreciable based on the information here that land is not depreciated. Now, if that is the case, that is why you find out that the only adjustment for depreciation here lies with office building and plant and machinery. Now, let's now make use of information available. We are told that the plant and machinery was acquired on 1st of January 2011, which was just last year, which means it will only have suffered depreciation of 1 year, last year. Okay, and we are told that the plant and machinery should be depreciated over 5 years on a straight line basis. Now let's go back to our fixed asset schedule in 2011. This is the schedule for the property, plant and equipment as at the end of 2011. And from the aspect of plant and machinery, it cost them 45 million, whereas the depreciation accumulated so far was 9 million. Now, if we make use of the information here, if it costs 45 million and is to be depreciated over 5 years on the straight line, how much per year? It will be 45 million divided by 5 years, and that comes to 9 million, which means the 9 million we are seeing here as accumulated in 2011 is just the depreciation for 2011 alone. Which then means that by 2012, the 36 million carrying amount will have been reduced further by another 9 million to arrive at something at 20, I think that should be 36 minus 9, should be 27 million, I guess. Okay, which then means that depreciation annually from here is 9 million, which will have been charged in 2012, and we need to add it back. Office building, let's read about it. Buildings are equally depreciated on the straight line basis over 25 years. Now, but what is the cost of the building? 75 million. If the building costs 75 million and is to be depreciated over 5 years, it then means that annual depreciation over 25 years, over 25 years, it then means that the annual depreciation is 75 divided by 25, which gives us 3,000. Now, how many 3,000 can you find in 15,000? That is, it has already been depreciated for 5 years as at 2011. The 6th year is the 3,000 for 2012, which is what we have here. Okay. Now there is no other adjustment required other than this adjustment. And the cumulative of that adjustment is 8 million. Now, the net adjustment is to add 8 million back to 15, which gives us 23 million. Okay, this 23 million is our adjusted, or what we can term our, adjusted profit in this case. Now, what I did now is that there was a loss, tax loss carried forward from last year. Okay, I brought this loss forward, 12.5. And I relieved the entire 12. Why? Because we have sufficient profit to more or less take or consume all of the losses. And the 12.5 loss, which was carried forward from 2011, which is here, it's what was used to relieve part of our profit to reduce it to 10.5 million. Now, the position here is that this is our adjusted profit, which is also our profit accessible to tax. Okay. Now, we have 10.5 million. The next thing is, do we have capital allowance balance unutilized last year? From the information we have, there was no information. Therefore, it means we assume it is zero, except otherwise given, directly or indirectly. Now, addition. Addition will come from the computation for the current year, okay, which we have not yet confirmed, and we are going to go there. And the issue of restriction to 6th to 3rd, I'll come to that. But now let's see, how do we compute our capital allowance? Let's look at our capital allowance here. Now, if you remember, land has no capital allowance granted because even for accounting purposes, it's not depreciated. Likewise, building here, we are giving information that depreciation on office building is not deductible for tax purposes. But for plant and machinery, tax deductible is granted over a period of 3 years, which means there's no capital allowance granted on building. In that light, we didn't compute capital allowance and tax retained value for building and for land, which is also confirmed from what Babajide said. But we compute for plant and machinery. Now let's go back to plant and machinery. In plant and machinery, please put up our cameras. Duncan, please kindly put up your camera. And the new madam that just joined us, Onome Agana, please.
Good morning, sir. Yes, I will do that shortly.
Okay, thank you, ma'am. Mr. Duncan, please kindly do that, please.
I'm driving, sir. Can I do this, sir?
I think because at every point in time, you've given us different reasons driving this and that. And I think the coordinator is not comfortable with it at all times. Okay, please kindly do that because they might take you off.
Let me.
Okay, please, huh? Okay, let's start from the point where the asset was acquired. What is the cost? Now, the asset costs how much from the information here? Plants. Plant and machinery. It cost us 45 million. Or figure in thousands. Now, capital allowance was said to be, from the information here, was said to be 50% in year 1, 30% in year 2, and 20% in year 3. 50% on cost in year 1. That means 50% of that. And what is written down value? The tax written down value okay. Now in 2012, we have capital allowance, and we are told it's 30% on cost. If you could remember here, and 30% on cost is 13.5. Therefore, what is the written down value? 9,000. And in 2013, we are told it's 20%. And 20% on cost is 9, which means the written down value is nil. That means the asset is fully granted capital allowance within a period of 3 years. Now, which means what is relevant for 2012, which we are more or less to look at, is additions. Our addition is this 13.5, which is equal to what I have here with respect to 30% of 45,000. Okay? That is that. Now, I assume in Nigerian context that your capital allowance is restricted to 66/3 of your assessable profit, which is 23,000. Now, 66/3 of that is 13,500. But we have a problem there. If we deduct 13,500, it's going to throw the 10,500 into negative, which is not possible. Therefore, what happens is that there is no amount you can relieve, regardless of 66/3, that can be more than the profit available after deducting your losses. Therefore, what do? We can restrict it and say we report minimum of what we have as reported and what is available for deduction. And what is available for deduction is 10.5. What do I have here? No, sorry, because I put negative sign there, therefore I'll put maximum. Which means at the end of the day, even if your 66/3 is more than is lower than your assessable profit, as we have seen it here, but because of loss you have relieved, you can't deduct more than 10.5. Therefore, everything results back to 10.5, which means at the end of the day, you have capital allowance of 3,000 to be carried forward. Now, at the end of the day, we have no taxable profit, which is 0. And when you apply tax rate on 0, it gives you what is 0. That is that. Okay, now you can find out that the loss was totally absorbed, which means nothing was carried forward here, because what is to be brought forward in 2013 is as a result of carried forward in 2012. Similarly, capital allowance that is unabsorbed was 3 million in 2012, which was carried forward in 2013. Now we'll do similar thing for 2013, which means in 2012 there's no current tax because our taxable profit is nil. Now in 2013, we have 20 million as our profit, accounting profit. And in this 20 million, we are told that 5 million has been considered as non-taxable revenue. What then do we do in this case is to deduct it. And remember, we have computed our depreciation that on a straight line basis, depreciation for office building is 3 million and depreciation for plant and machinery is 9 million. And that's what we have done here. At the end of the day, our total adjustment is positive 7, which is added to 20 million. At the end of the day, our adjusted or our assessed profit is 27. Okay, now there is no loss to be relieved. Therefore, what do we have? We have 3,000 brought forward from last year being unutilized capital allowance. And for this current year, you have 9. Where do you get the 9? Remember, we computed that our capital allowance for 2013 will be 9 million from our rate of capital allowance given to us. And in that light, what do we have? 9 million. 9 million plus 3 million gave us 12 million as the total capital allowance that we need to enjoy. And based on the fact we have sufficient profit to absorb it all, regardless of the restriction by 66/3, and we can deduct the entire 12 million from 27, which gives us 15. Now, what is our enacted tax rate in 2013? Let us come back here. They said Skelewu Nigeria had a tax loss on 31st December 2011 of 12.5 million. The tax rate for the year 2011 was 35%, while 30% for 2012 and 2013. And that's why we have 30, 30 in 2012 and 2013, as opposed to 35, which occurred in 2011. And that is that for current tax. Now, before we move to deferred tax, which is the main discussion, I want any question here, if it varies from our understanding. Welcome, Mr. Ayodele. We can't see your face. Okay, any question here? Babajide, Nuruddin, any question on this first aspect?
My question, sir.
Okay, sir.
I didn't know the reason why you did not restrict 12,000 on that capital restriction. Now apply 60 to talk about 12,000. Despite the fact that we have 27,000.
Yes, I apply 60
as the profit.
We apply 60 to third. Now let us look at it. 60 to third is the same thing as 2/3. 2/3 of 27,000 is how much? It's 18. And 12,000 is less than 18, which means you can't absorb more than 18,000. Yeah. That's what it means. And we have 12,000, which means you can absorb all of the 12,000. Supposing it's 20,000 we want to absorb, you can't absorb more than 18, which means 2,000 will be carried forward. That's what that restriction means, sir.
Okay.
Which means
so
12,000 is below.
You can see. You can see that means we can still do 100% of that.
Yes,
on our profits.
Once it is below, you deduct all your capital allowance. Once it's below, I'll show you an example of where there's no restriction. Because restriction applies in some industry, it does not apply in other industry. Like in agriculture and agro-allied, restriction does not apply.
Okay.
Any question at this point, sir? Any question? Babajide, does it align with your thoughts?
I just want to ask maybe a flashback on the year 2012 for the 2/3 of the 10,005. That will be lesser than 10,000.
Not 2/3 of 10,005, 2/3 of accessible profits.
Oh, okay.
Restricted to 2/3 of accessible profits. That's the position of the law.
Okay. Which is 2/3, how much?
2/3 of 23,000. If you check 2/3 of 23,000 is how much? That is 15,000.
15, okay, which is
which is lower.
Lower.
What we have is lower, 13,500.
Okay.
But because there is only 10,500, we can't deduct more than 10,500 because we have already used loss to suppress this 23.
Okay.
Does that make sense, sir?
Yeah.
Okay. Any other question? Okay, if there's no question, now let's move to capital allowance. Deferred tax. Now, to compute deferred tax, we start from 2011 because we have sufficient information in 2011 to obtain our closing deferred tax position in 2011 because it's critical for us for opening position in 2012. Now, what is deferred tax again? When you compute deferred tax, in this case, we are computing on land, plant and machinery, and office building. All of them constitute what we call an asset. All of them constitute what we call what? An asset. Now, we want to compute deferred tax. Two things you need in computing deferred tax are the tax base and the carrying amount. Luckily for us, we know what the carrying amount is. Okay. The kind amount for land is 25,000 because it is not depreciated. The kind amount for office building is 60 after we have depreciated 15 all over the years, which is 60. And the kind amount of plant is 36 after depreciating just for 1 year in 2011, which is 36. Okay. In that regard, we have kind amount, which is easy for us because that is what we know how to do best as accountants. But what is the tax base? Remember, what do not have a tax consequence as an asset? What will be the tax base of such? Can we remember? Can we remember from our
It will be the same to the carrying amount.
Yeah. Therefore, you find out that land, we have tax base equal the kind amount. Building, we have tax base equal the kind amount. And that's why when you come here, I said something here. Okay, I think okay. If it's not there, I can show you something here. Let me show you on our presentation slide last week. Sorry, I'm opening this. Okay. Now, what do we say here? No, it's not the slide. Okay, can we see it now? Babade, can you read something here from the consequence here?
If the economic benefits will not be taxable, the tax base is equal to its carrying amount, and therefore there is no temporary difference or deferred tax.
Continue.
Where an asset has no tax consequence, the tax base of such an asset is equal to the carrying amount. Therefore, the temporary difference equals 0 or nil.
Let's now harness that to our discussion here. Which means in this case, our tax basis for land and for office building will continue to remain the same across the years to which we are computing deferred tax. The only one that varies is the plant and machinery. And for year one in plant and machinery, what do we have? The written down value, which equals the tax base, stood at 22.5. And that is where we get this 22.5 from. Okay, which I also showed the calculation there. Now, that gave us the only temporary difference. And what is the tax rate applicable as at that point? Now, the dilemma we have is, are we to use 35 or are we to use 30? Who can answer that question? Who can answer the question? Are we to use 30 or 35? Based on this last sentence here, the tax rate for the year 2011 was 35% and 30% for each of the years, 2012 and 2013. Who can answer that question?
I think we have to use 30%. Yeah, because
Right?
we must apply the tax rates that relates to the period that the figures relate to. For instance, this is deferred tax that relates to a subsequent period, and we must use the tax rate that is relevant for the subsequent period.
Okay, who else? Who else? Who else? And now, you said the writing screen is dark. I didn't get that. Can you unmute yourself and make comments?
Yes, I say dark. There is tiny, a little bit tiny, so I just wasn't seeing them.
Are you making use of your phone or you are making use of laptop?
Using a laptop.
Yeah, but it's not dark here because I also have a second laptop I'm using to check. Guys, is it dark? Is it not legible enough? I didn't get it.
It's not, it's okay. It's not dark. From my end, it's not dark.
Can I make a contribution, sir?
Yes, ma'am.
Okay.
Yeah. Tax accounting year is different from tax year. If the tax year is 2000 and if the accounting year is 2011, the tax year will be 2012. So we are making use of 30% because the accounting year is 2011.
That they don't want to renew the rent.
I don't understand tax year. You know, deferred tax is purely accounting. It's purely accounting related.
Okay, we are using 30%, sir.
On what basis?
Yeah. Now using, sorry.
Mr. Ayadele, what rate are we using?
We should use 30%. Reason why being that according to the lecture we had last week, the plant and machinery, its effects is having a future tax implication. So we should use the rate applicable in the future, which is 30% that's applicable to 2012 and 13.
Now, let me now play devil's advocate.
Which is,
if you are to use the rate in the future, if as at today, 31st of December 2011, government has not changed the rates and you don't know what it is in the future, what rate will you use as at today? Is it 35 that was ruling as at today or 30%? I can't hear you, sir.
That would be 35 that will be ruling as at today. If there's no future tax.
Yeah. You know what this question has put to us is that the question was silent about when was the pronouncement Or when was it legislated upon that the new rate of 30% will take effect in 2012-2013? Now, what it simply means is this. I'll give you two scenarios. In 2011, government may have pronounced that the new rate is 30%, but it will take effect from 2012-2013. And it's also possible that in 2011, there was no pronouncement, there was no legislation until January 2012, when there was a pronouncement. The question then is, based on the position and requirement of IAS 10, event after the reporting what date. Now the question is, can we go and adjust for the rate as an adjusting event or as a non-adjusting event? Because the information and the condition was not existing as at the end of that reporting date. Therefore, such cannot be adjusting, which means when you are not spirit, how do you know that it will be 30% as at 31st December 2011? When such pronouncement, such law, nothing has happened. Only that it happened probably in January, February, March, before the end of 2012. Am I making sense? But the unfortunate thing in this question is that we have no such information. We have no such what? Information. But one thing we need to be rest assured about is that if we look at it in practice, no government of a nation will just rise up overnight and change rates. There must have been a process instigated, initiated before such takes effect. I mean, okay, which that means that it is very unlikely that as at 31st December 2011, such information about a rate change in 2012 going forward wouldn't have been known in the public. Which that means that we can rely on that premise to say, if that is our assumption, that there is a pronouncement in 2011 of the rate change that will take effect in 2012. Therefore, we can now conclude to say substantively enacted tax rate, which is 30%, is what we use for deferred tax computation in 2011. If not, if we have an express information that the rate was changed in 2012 and it was to take effect also in 2012, therefore we can't use 30% for deferred tax computation in 2011, because that would be like using the benefit of hindsight to adjust for non-adjusting events. Does that make sense, please? And now, does that make sense?
That's last statement. Again, sir.
What I say is that except there's an information that states that such rate was only made known in 2012, you can't go back retrospectively to adjust for a non-adjusting event in 2011 as at 31st December, because you can't use benefit of hindsight to do so. Does that make sense, sir?
Yes, sir.
Okay, which means we all agree to use 30%. And upon 30%, that's how we got 40-50. And that 40-50 is what serves as our opening deferred tax liability in 2012. Okay, this is 2012, we've done this. Now, remember, we have unutilized tax losses carried forward from the information here in 2011 to the tune of 12.5. And unutilized tax losses will give rise to deferred tax assets once it is carried what? Forward. Now, and the rate of tax applicable is still 30%. Okay, if you remember, we did it here. Can you read this? Can somebody read this technical note here?
Okay, current tax computation is not required, but the methodology that leads to current tax is indirectly required in order to ascertain the unutilized tax losses and credits carried forward for the purpose of determining the deferred tax consequence. Also, the income tax computation is only shown for knowledge purpose only, as it is not required. In computing deferred tax for 2011, that is as of 31st December 2011, it was assumed that the rate of 30% to be effective from 2012 has been substantively enacted as a tax rate. Hence, it necessitates the reflection in the computation of deferred tax for 2011, which alternative as deemed otherwise can be adjusted for on 1st January 2012. The solution is based on the application of the relevant position of Companies Income Tax Act, Cap 21 of 2004 as amended, regarding the restriction of capital allowance to 66 to third of assessable profits, except for agricultural and agro-allied businesses.
Okay. Now let's come to deferred tax assets. There was unutilized tax loss of 12.5 in year 2011. And since we have agreed to use 30%, 30% of that gave us 3.75, which means in arriving at our position of deferred tax, we've considered deferred tax liability on plants, we've considered deferred tax assets on unutilized tax losses, and there's no deferred tax asset on tax credit carried forward because there's nothing carried forward. Now, net, our deferred tax is what? 300, because we have used our asset to offset liability. And this is only permitted under two conditions. One, under the condition that there's legally enforceable rights. And this is only done if, one, both items that give rise to deferred tax liability and that give rise to deferred tax asset falls under the same tax regime and falls under the same tax jurisdiction. When I say tax regime, it means they fall under CETA. If one falls under CGT and one falls under CETA, they are not offsettable because they are two separate tax regimes. Because you can't use your excess in CETA to pay for CGT. No, they are not the same tax regime. And also, even if they are in the same tax regime, they must also be in the same tax jurisdiction. Luckily for us in Nigeria, we only have one jurisdiction for company taxes, which is Federal Inland Revenue Service. But if you are in a country like United States, where you have different tax jurisdiction across states, because it is the states that administer company taxes. Therefore, we need to take note of that. Okay, that is the first thing we need to take note of, which means as at the end of 2011, our deferred tax is net of a liability of 300. Now let's do for 2012. We do the same thing for 2012. Remember, that both for land and office building, the tax base will always equal the carrying amount based on what we have explained earlier, on the premise that they have no tax consequence, except for plant and machinery. And what is the tax base for plant and machinery in 2012? Remember, we computed it here, which is 9 million. And that's what gives us 9 million. And 18 million is temporary difference. This temporary difference, is it taxable or deductible? If you remember, since the kind amount of a plant and machinery, which is an asset, is higher than the tax base, what will it give rise to once again, my guys? What will it give rise to?
Taxable by difference.
Yeah, and once you apply the tax rate, what will it give rise to? Deferred tax asset or deferred tax liability?
Deferred tax liability.
Tax liability.
Okay, now that is where we got this deferred tax liability from, 5.4. Now in 2012, there's no unutilized losses because if you check here, it is nil. Why is it nil? Because if you go by our income tax computation, in 2012, it has been totally absorbed. Therefore, there's nothing left again. Okay, therefore it is new in that case. But we now have deferred tax asset to be computed on unutilized capital allowance, which is 3,000 because it is unutilized in 2012, which means it's a credit to be carried forward to 2013. Now, what do we have? 3 million as unutilized, not 6.5. Therefore, which is 900,000. And that 900,000 is what we find out here as unutilized tax credit carry forward. When we net it, what do we have? 4.5. Okay. And in 2013, which is the last year of our computation, our tax written down value, which is our tax base for plant, has become 0. Why is it 0? When you come here, it's 0 because it has been fully granted all of its tax benefit by way of capital allowance. Now that 0 is what is here, and so that we have a temporary difference of 18. Now that 18 is taxable in nature, and multiplied by 30% give us a deferred tax liability of 5.4. That 5.4 is what we can find here. And in this year, because we have no unutilized tax losses, because we have no unutilized tax credits, none of them give rise to deferred tax assets. And in that case, there's nothing to reduce our deferred tax liability in that year, which means invariably our closing balance in 2011 was 300, closing balance in 2012 was 45, and closing balance in 2013 was 500. What does that signify? It signifies that we can use that to determine our deferred tax expense and credit for each of the years. Now, our deferred tax liability brought forward in 2012 is our closing of 300 in 2013, which is this. I can use color to shade it. And our closing balance in 2012 is what we'll compare with it and showed a movement of 4.2, which means there's an increase in deferred tax liability. And remember, an increase in deferred tax liability is an expense. Is what? An expense or a charge. Okay, and that is that. I remember this 4.5 is what you carry forward to 2013. And in 2013, we have our deferred tax computed to be 5.4, which is compared with 4.5. Therefore, there's also a slight increase of 900, which is our deferred tax charge for 2013. Now, remember, we have done our current tax to be 0 and 4.5, respectively, in 2012 and 2013, which is 0 and 4.5. This is 0. I'll show you where it came from. It came from here. And this is 4.5. It came from here. And remember, our deferred tax charge is what we have here, 4.2 and 900. Okay, if it's a credit, we'll have used it to reduce our charges for income taxes. Okay, which means when you net it off, what do you have? Our income tax expense for the year 2012 is 4.2 and 2013 is 5.4. And that is our position in that regards. And that's more or less represent our solution, all true in that regards. Any other question? Any other question? Which means our solution ends here. Any question?
I don't have any question, but honestly, I didn't do it the way you did it here, but I really appreciate the solution because it gives a lot of clarification to it and is understandable.
Thank you. Any other commentary?
Yeah, thank you very much. Actually, I want to raise the same observation as per the requirements of the questions, which says we should compute the deferred tax accounts. I assume that the question was not correct originally, but thank God for the note and the explanation to justification to this question. I really appreciate it. Thank you.
Okay, now there's a twist to this solution if there's no restriction. I also did the solution such that there might not be restriction, okay, but again, the principle remains what? The same. Do you get what I'm saying now? If there's no restriction, you still get the same similar result, but slightly different. You get what I'm saying now? Okay. Any other question? Okay, if there's none, I want to share this with you. And I want you to look at it for a few minutes, and I will explain what it is. Okay, looking at what we have on the screen, who can explain what you've seen before I put an explanation to it? Who want to put explanation to this? Mr. Shegun?
Okay. Yeah, this is a deferred tax schedule, and on the extreme left column we have the list of assets and liabilities. For instance, if you have property, plant, and equipment is an asset, when the carrying amount is more than the tax base, we have the taxable temporary difference that we are seeing here. And when the tax base is more than the carrying amount, we have the deductible temporary difference. And there's a tax rate of 30%. So when the tax rate of 30% is applied on the taxable temporary difference, it gives us a deferred tax liability. And when the tax rate of 30% is applied on deductible temporary difference, we have the deferred tax assets. And it's like that for the asset class. Let me go to the liability class. For instance, the unrealized foreign exchange gain. So when the carrying amount is more than the tax base, it gives us the deductible temporary difference. That is when the carrying amount of a liability is more than the tax base of that liability, it gives us deductible temporary difference. But when the carrying amount is less than the tax base, it gives us taxable temporary difference. And it's just like that when we apply the tax rates, we can easily class it as either deferred tax assets or deferred tax liability. And the deferred tax assets and liability we report in this summary of scheduled taxes up here, so that we can have the net deferred tax liability or assets. And that will also flow into summary of deferred tax on the top right corner to arrive at the deferred tax liability or deferred tax assets as at the year end. So that is my contribution, sir.
Okay, thank you, sir. Any other person?
I think I'm seeing a model. That's what I'm a deferred tax model. That's what I'm seeing. So once we input those figures, I think it does the calculation. That's what I'm looking at.
Okay, who else? Okay. Madam Grace, you need the experience here. Madam Grace. Madam Grace, are you with us?
Yes, sir.
Yeah, we need the experience here. We can't hear you. Madam Grace, you are muted.
Let's progress. I know there is a model, but I need to understand, to really study.
Shadu, look at this thing. Why do we have 30% here for property, plant, and equipment, and we have 32 for others? Does it make sense?
And
of course, how do you go arrive at 32 in Nigerian context? How do you arrive at 32?
Yeah, honestly, I don't know.
Okay, who can answer?
Yeah, but yes, it's like that too.
How do you arrive at 32? Babajide, can you mute? Yeah, it's noise from your background, please. Okay, 32 is made up of 30% company income tax and 2% accessible education tax, which is on accessible profits. Now, the reason why it is 30% for plant and equipment is because capital allowance is only enjoyed to the tune of 30%. How? Let me show you back our computation for last time when we started from. Remember our current taxes. You find out that tertiary education is charged at 2% on the profit here. But this is after you have enjoyed This is before you have enjoyed capital allowance and loss relief. And thereafter, what is left is charged as 30%, which means every other thing will suffer 32% as benefit or deduction, while asset for capital allowance purposes and loss relief will suffer 30% because that's what is applicable after. Am I making sense?
Yes.
Because we don't use loss relief and capital allowance to reduce the amount of taxes for education tax. Therefore, the tax burden on it is 30%, while for others is 32%. Does that make sense? And that is why you see here that when we come to capital allowance, unutilized capital allowance carry forward and unutilized tax losses carry forward, we make use of 30%. Can you see it here? Does that make sense, please?
Yes.
You are looking? Does it make sense?
Yes, it makes sense to me.
Yeah. 2, we said deferred tax is computed on asset and liabilities. But in the financial statement, these two are not asset and liabilities. Or they are asset and liabilities of which the carrying amount will always be 0. Who can explain that? I repeat, unrealized foreign exchange gains and unrealized foreign exchange losses are not considered asset and liabilities for financial reporting purposes, or of which the carrying amount is 0.
I hear you.
Whereas the tax base varies.
I can't hear you.
Hello? You can't hear me? I think your network is breaking. It's your own network. Can you guys hear me?
Okay, I can hear you now.
Okay. Now, I said unrealized foreign exchange gains, unrealized foreign exchange losses are not asset and liabilities for financial reporting purposes. Or they are asset and liabilities to which the carrying amount is 0. But for tax purposes, they have tax base other than 0. Who can explain that in practical terms before I comment?
Can I try?
Yes, that's why you're here.
Okay.
You can.
I think the unrealized foreign exchange gains and losses arises as a result of translation of foreign currencies, and the gains or losses will always be through other comprehensive income. So it could have a tax implication, but it's still the exact no, I think I'm getting it wrong. Yeah, I'll wait for the explanation, please.
Okay, first, let me correct you from the point you started. You said they are reported in other comprehensive income. That is not necessarily correct. Okay, later on we'll get to IS 21, where we'll talk about the effect of changes in FX rates or exchange rates. Now, the question is this: before you conclude whether it goes to profit or loss or other comprehensive income, you need to more or less identify on what kind of assets and liabilities do these exchange differences arose. Are they monetary items or non-monetary items? I won't break it down here because we have not gotten to that level. But when we say monetary items, which are assets and liabilities, we are talking about like receivables, we are talking about payables, we are talking about cash. When we talk about non-monetary items, we are talking about things like stock, inventory, like property, plant, and equipment, like investment that is not measured through fair value, to profit or loss. Do you get what I'm saying now? Like capital and etc. Okay? If there's an exchange difference arising from monetary items, the one attributable to cash, debtors, receivables, such unrealized loss or gain goes to profit or loss. While for non-monetary items, those arising from inventory, PP, investment other than those mentioned as fair to profit or loss will go to other comprehensive income. Does that make sense now?
Yeah.
Therefore, which means your proposition may not be valid. Who else can explain in the context of what we are discussing? Or let me give you a clue or a guide. Can we start from this? How is unrealized gain and losses treated for tax purposes in Nigeria? Who will guide me on that? Nuruddin Bashiru, are you there?
I'm here, but I cannot help.
You cannot help. Ah, okay. Madam Oladokun, I've not heard your voice today. And now, I think you want to help.
Well, I would say
Yeah.
for that one, let me just try. I will only try. I'll just say that since it's unrealized for tax purposes, is not it doesn't apply to, we don't pay tax on it, or we don't unrealized gain. We can't pay tax on unrealized gain until we realize it before we can't pay tax on it. So
And likewise, unrealized loss, you can't enjoy it for deduction unless it is realized. Have you?
Yes.
Is that correct? Does that give rise to deferred tax? Or does it give rise to temporary difference? Yes or no?
Yes,
And you must justify.
Yes, it gives rise to temporary difference.
Oh.
Hello? I didn't hear.
How? Yes, can you justify how?
Yes, if for unrealized exchange gain, I see that it gives rise to a taxable difference. It gives rise to a taxable difference. So, and because by the time the gain is realized in the future, we'll likely pay tax on it if it does realized. If we do realize it in the future. And the same thing for losses, for unrealized foreign exchange losses, the tax man will definitely not tax us, or we cannot carry it. We cannot. It's not a deductible for tax purposes since it's unrealized. But but by the time it is realized, the loss is realized, it becomes a deductible. So it's an asset. So there's a temporary, the temporary tax difference.
Okay, let's test that understanding. I told you that unrealized foreign exchange and losses are no assets or liabilities for accounting purposes. Therefore, their values are always zero, because you don't see them in your balance sheet. Why? Because you have already reported them either to profit or loss or OCI, which has hit on your reserves. Okay, but what is the tax base of these items? The tax base of the item is the amount that you have recognized as unrealized gains. Let's assume that in that year, the amount we have realized for unrealized gain is, let me say, our unrealized gain in the current year, which we assume that exists for the first time. Let me say it's 1 million. Now, what you will see here is that 1 million is reported there. Okay. Okay. And for unrealized loss, let us say it is 600,000. Let us assume they are different items. Let me say 600,000. Okay, now you find out that there's this is showing the same position. There's something wrong with that, which is not correct. Okay, because it's supposed to give me, okay, sorry. I was putting negative. Okay, that's why. That's why it's giving me something wrong. You know, how did the negative find itself here? There's no negative there. Okay, it has normalized now. There's no negative there. I've tampered with the model. Okay, now what you have explained, and now does it align with what you have explained?
Yes, it does.
Yeah, which means unrealized FS gain will always give rise to deferred tax liability. Why is it that? Because government did not tax you now. They are waiting for you when you actually realize it, which means at the point it has cash flow impact or implication, which is next year. And by then, you'll be taxed more because this year you have seems to have enjoyed benefit and it will expose you to higher taxes tomorrow. Why conversely, unrealized loss means that today that you're supposed to use it to reduce your tax, the law says no, that you can only use it to reduce your tax until it has affected your cash flow and you have lost that value invariably, which means next year, by the time you realize it, it will be used to suppress your profit. And that's why it's an asset. Now, let's now pick items, for example. Let us randomly pick. Can somebody give me millions? What is the kind amount of all your property, plant, and equipment?
Wait,
Can
please,
somebody give me a million? Yeah.
Please, what are transactions that give rise to unrealized foreign exchange gains and losses?
Transactions. Anything that has foreign currency, which is different from your functional currency, will give rise to unrealized exchange gain or loss. By the time you translate it as at the reporting date, at a rate different from the historical rate. Which means when you have a foreign currency, what I explain is how do you know the portion of unrealized FS gain or loss that you are going to report through profit or loss and the one you are going to report through other comprehensive income? That is when I did explain about monetary asset and liabilities and non-monetary asset and liabilities.
Sorry, I want you to explain the unrealized in it.
I didn't get it.
The unrealized, the word unrealized.
What is unrealized? Unrealized means that even though your exchange, the exchange rate has moved against you or has moved in your favor, but that has not necessarily impacted you with respect to your cash flow today. It's only by way of accounting measurement that says you should translate those balances at today's rate because you have to report your financial position as at that date. Is that okay?
Yeah, very okay.
But again, there is a discussion coming on that, IAS 21. Okay, pending when discussion will come, you can go on YouTube to watch about 1 hour or 2 hour video in which I did for people like you on the effects of changes in exchange rates. I used about 6 questions to explain the implication of that in financial reporting. Any other question? Any other question? Okay, now can somebody give me the kind amount of PP? Just think abstractly to say, okay, our PP for this year amounted to how much?
50 million.
50 million. Okay, if that is the case, what is the tax base? You know, based on your tax schedule of capital allowance, deduction, and everything, what is the tax base? Just give me any abstract value. Can you give me abstract value?
30 million.
30 million. If it's 30 million, it gives me taxable temporary difference of 20, which gives rise to deferred tax liability of 6. What if it is higher? What if it is higher?
To give us the
What will it give?
deductible difference.
Okay, give me a higher value. Let's say 6.
Mm.
Can you see it becomes deductible? Okay, now let's randomly do for others. Let's say we have this of 5.3. Eventually, let's say I have for 20. Trade receivable 35. Cash and cash equivalent 2 million. Loans 45. Payable 24. Deferred revenue 1. Can we mute? And as decommissioning cost, which is safety as asset retirement obligation, we'll discuss that when we get to IAS 37 for provision. Let's say that is 6. Okay, now you can see those ones that may not necessarily have implication. You can see that it's populating the tax base. Okay, but what I will also do, is that here you start to ask some questions. Even though we always have a tax base equal kind amount, except if you have a write-off. When you have a write-off by tax law, if such a write-off is not allowed for deduction until the inventory is finally sold in all. Therefore, that will bring about difference between tax base and kind amount. Trade receivables, if we have any impairment loss, you understand, such impairment loss will be added back to the kind amount. Okay, now, but in this case, we have no impairment loss. That's why this is coming in. But if you have impairment loss, this will not be the same in this case. Now, let me now say we have impairment loss. The kind amount is this. I will add back impairment loss if it's not actually a bad debt that's acceptable for tax purposes. The amount of impairment loss, allowance for credit losses, which is the same thing as impairment losses. On trade receivable, I'll add it back. Let me assume I have 3.5. Okay, let me assume that I have write-off. If I have write-off, I'll add it back. Not yet realized on sale of goods or sale of inventory. Because most times, tax law of various jurisdictions only allow write-off for tax deduction once that inventory has been eventually sold. Let me say that is just 500,000. Other assets, it doesn't have. Borrowing, it doesn't have implication. For that is 0. This also probably it doesn't have is 0. This will populated that. Okay. this is out of it because it falls under a new tax regime, which okay. Now, on that premise, we've completed everything. Deferred revenue has zero tax base. Remember the principle of our discussions. Asset retirement obligation also, if you remember, we are still going to discuss all those ones as time goes on. Okay. Let me just put here, refer to our discussion because I'll make it available for you. Refer to our discussions on tax base. And we are still going to discuss it when we get to IAS 37 for provisions. Okay, that is that. Now you can see how everything generated deferred tax liability on one side, deferred tax asset on one side. Now let me take this back to what it is, 30 according to Jide. Okay, now at the end of the day, this is what we have. Now let's assume that at the end of the day, we have unutilized tax losses and tax credits. Now, can somebody give me an amount of unutilized tax losses carried forward in the current year? Who will give me that? Just give me a random figure.
5 million.
10 million. You know, it has a tax base of 10 million. Okay, say 10 million. Okay. Let's assume investment allowance, we're able to enjoy it in that year. Let me put it 0. Now, other tax credit, other capital allowance that were unable to be absorbed, let's say it's 3 million based on the question we solved this morning. Okay, these 3 will give us deferred tax asset, which means our deferred tax asset is this and this, and our deferred tax liability is this. All of them are populated here. Okay, I didn't put it in negative. That's why I'm showing that. Okay. Now, at the end of the day, what do we have? We have net of deferred tax assets at the end of the day. This is net of deferred tax what? Assets.
Asset.
Now, that's what we'll get. Imagine this is like 20. Let me see what impact will it have. Therefore, you see that we have net of deferred tax liability. Okay, now we don't have our opening balance. Somebody should give me an opening balance. Let us say from last year, we had 2 million as our opening balance. It then means that in the current year, we have a charge. No, we have a credit of how much? We have a credit of we have a credit of 292,000. But let's assume that it's 1.5 that we had as our opening balance. We have a charge of 208,000. And that's what it means. Therefore, let's assume that, okay, we return this to 30,000, 30 million. Therefore, but we have liability brought forward because it's positive, asset is negative, but at the end of the day, we had it turned from liability to an asset. Therefore, we have a credit of 2,792,000. Therefore, this is what we mean by computing deferred tax as a whole. Any question before we move forward? This is where we stop with respect to deferred tax. If you have any question, let us ask. Okay.
I have a question on how we get the tax rates.
How we got tax rates?
Those tax rates, though they are different. No, we have 30, we have 32, we have respect to different.
We extend that just quite long, about 20 or 15 minutes. Shegun Adeomi, can you answer that question now?
Okay, yeah. The explanation is that the 32% is as a result of 2% education tax. Okay. And that 2% education tax is not levied on property, plant, and equipment that's enjoyed what is it called? Capital allowance.
Okay. Okay.
Now, sorry, Mr. Ayodele, can you see your screen now?
Yes.
Okay, on your screen, can you take us through the assessment of prompting to tax based on tax law? And as you take us through, in a summarized version, we will see the pointer to where the rate we obtain at 30 and the rate at 32. First, you must know that 30% is company income tax rate and 2% is a tertiary education tax rate. Now, can you take us through this?
The calculation here was the calculation of current tax, and after computing the accounting profit, which is 100,000 in millions, we add back add back the tax adjustments, non-allowable expenses, which is classified onto expenses that failed wholly reasonably and exclusive necessary test, 2,000. The depreciation and amortization, 12,000, and loss on disposal of asset, 800. Sorry, please stop that. Then totaling 14,800. We add it back to 100,000. Then another adjustment is non-taxable income, which is all these totaling 3,800. Then omitted allowances also, we less that one too. Then omitted taxable income also, which amounts to 1,500, we add it up. We now get our profit adjusted for tax purposes, our assessable profit of 101,880. Then if you have loss relief, according to this question now, there's loss relief balance forward, brought forward was 18,000. Then relief for the year is relief entire 18,000 for the year. which is releases from the 101. We now get 83,880. Then we now less capital allowance. We have balance. If you have balances brought forward, we put it there. There's a balance brought forward of 5,000. The addition for the year for the capital allowance is 3,500. So making 8,500. Then we now absorb the entire 8,500 from the 83,880 balance we have. So we now have a taxable profit of 75,380. Hello. Yeah, I can't see the screen. I can't see the screen again. No. The screen is yeah. Now I can now. After the absorption, now estimated current taxes is now as a company income tax is at 30% of the taxable profit. That taxable profit you have here is 75,380. So we have 35% of 75.4 million, which is 22,614,000. The tertiary education tax at 2% of accessible profit. Our accessible profit here is 101,800. That is the amount we got before the loss relief. So the 2% of that gives us 2,038,000. Then information technology development levy at 1% of accounting profit. This one is of accounting profit. The accounting profit was the profit we have earlier, or that is before the adjusted profit. That's 100 million, so 100 million. So that one is 1% of the accounting profit. The capital gain tax of 10% of chargeable gain. Chargeable gain, 10% of 4 million is 400,000. So the total current taxes is now 26,052. Hello.
Okay, yeah, now look at what we have said, all true. PPE that will make use of 30% for is the one that gives rise to capital allowance, Abi? And capital allowance for below the line, when the rate applicable is 30%. Why? Same thing, loss relief falls under that below the line, which applicable rate is also 30%. But every other item falls above the line. When the rate, apart from 30%, there's an additional tax rate of 2%. And that is why those ones have 32. 2% above the line, which is for tertiary education tax, and 30% below the line, which is for education. But capital allowance and loss relief do not have any impact on tertiary education tax. Does that make sense, sir?
Yes, sir.
Yeah, that is what happened. That is where we derive our rate from. Remember, we did discuss this. Let me show you the PowerPoint again. Can you remember this?
Yes.
Can you remember this?
Yes.
Can you see this?
Temporary difference.
Can you see this diagram where we talk about? Can you see it?
Yes.
At that point, we talk about tax rate that is applicable. Okay, it's from here that we discuss what rate of tax are we going to use, which is synonymous to what we discuss here. It's synonymous to what we discuss here in our notes. that we shared. If you remember, when we say what tax rate is applicable, remember it here also?
Yes, yes.
That speaks to it all. Any other question? I'll provide the solution today, and I'll also provide the model template I developed. Now, let me show you something about the secret of that model, which means you marry your understanding of deferred tax with your understanding of Excel, so that going forward in life, you won't be thinking so much to compute deferred tax. All because you just need to find your feet and your figures and plot it in. Everything populates itself. Even here, instead of putting your tax base here, you will have linked this side to your capital allowance computation schedule, where everything you compute on your capital allowance schedule will automatically populate here, and it will automatically link here. That's how it's done. Now, look at it here. There are formulas written here, which, let me enlarge it for you to see. Can you see it now? I've tried to enlarge it. Now, if you look at this 25 million, why is it reporting as taxable? It has considered series of functions. If you look at the top bar, it says if this 16 is an asset, which means if the class is an asset, and you find yourself in a situation where the kind amount is greater than tax base, it then means that it is taxable. Otherwise, it then means that it is what? Deductible. That's what all of those formulas is. Which means the formula is a dummy. It's reflecting the logic built in all of our discussion about this table. Remember this table? Let me show you the table again. Can you see this table again? From our notes. Can you see this table?
Yeah.
What this table says is what I've conditioned on the model. I've just modeled this table in the equation, so that anytime, any day, I don't need to think. I'm just plotting my score as a plug and
taxable. Okay. Yeah, taxable. Oh yes, current amount is less, and it is asset. That will is liability taxable. Okay. That's not liability. Current amount is an asset. Current amount is greater than tax base. This is an asset. Taxable difference. Is a liability deductible. And it is data. It's an asset deductible. Okay.
okay. Now let me take you back to the model template. Okay, that is what we've done for everything up to the point of determining deferred tax asset on others. Okay, and that is that. This brings us to the end of deferred tax, excluding deferred tax implication on some critical items, such as deferred tax implication on business combination and group accounts, adjustments. We also look at deferred tax implication on some other transactions when we get there, like inventory, where you have a write-off, even though that is straightforward, but where you have some critical one is on financial instruments. and some other areas to which you have deferred tax implication. But before you could discuss deferred tax implication of those areas, you need to also understand those areas very well. Because as I've said earlier, the nature of an asset is so important, the nature of a liability is so important that if you don't understand it, you can't be able to ascertain the deferred tax implication of them. And if you don't understand the legal requirement with respect to application of taxes or what will likely be the tax implications, you can't be able to determine the tax base. Therefore, all of these are what we conjoin together in trying to provide solution in this regard. And on that premise, we say that we've come to an end which account for about 90% of all of our discussion with respect to deferred tax and current taxes. Okay, at this point, we end it for deferred tax and income tax as a whole, and we'll go on our recess and we'll come back in 15 minutes time, which is 1:15, to introduce ourselves to the new topic, which is a baby. It's also going to take us a very long period, but we are not going to do it as stretch, the same way we did deferred tax, but it's going to take us longer period than deferred tax or income tax, but we are going to break it over time so that other courses or topics will come in between. And what we'll be discussing next is accounting for business combinations and how that leads to the preparation and presentation of group accounts. Now, some has gotten their own materials, okay? While those that have not gotten their materials, they should liaise with me to get their materials on business combination and group accounts, okay? But I've also gotten across to you various copies of the standards, okay? If you have not gotten yours, please communicate with me on WhatsApp and send me your email address if you have not. But for the physical material, what's the material I'm talking about? Let me get it for you though. Significant number of you guys already have this material, okay, which is on business combination and group account, which is the material I wrote, and that's what we are going to discuss going forward. We'll be making use of information contained therein to demystify our understanding of it. Is that okay? Any other question before we go on recess and return in 15 minutes time? Shegun, yeah, you said you sent somebody to me to get your copy down to France. But in the meantime, you can also subscribe to it on Amazon for $20 for soft copy. So that I can have the soft copy version with you. Just go on Amazon for Kindle, subscribe to the soft copy, which is the same thing I'm sharing on the screen now. Okay.
Okay.
In the absence of none, we'll call it a day. Not a day, sorry. We'll call it a midday. Okay, we are coming back 15 minutes time to continue. Thank you very much.